Hello traders, welcome to the Markets in 3. My name is John, Senior Market Analyst here at Anzo Capital. I'm here to provide you with the latest information on all things markets, some key charts to watch and a skill of the day. So today we're going to be going through some key features, and the main thing we're going to be talking about today are the Euro, US dollar and gold levels to watch ahead of the Federal Reserve meeting. But before we get into that as our big story of the day, we're going to go into the chart check. The chart check is the part of the show where I like to focus on a particular market, draw up some key areas of technical analysis and see what could potentially happen next. Add a little bit of a macro element to it as well so that you get a reasoning of why behind the moves. So we're actually starting off today with the US 500, the S&P 500. Now, if you trade it from a CFD point of view, as the ticker on your chart, it's going to be US 500. And what we're going to talk about is what has been happening in the stock markets. We actually saw a serious increase or a serious gap on Sunday. So let me just show you that there. So on Sunday, or let's say on Friday's close, we closed around about $7,408. We then gapped up on Sunday's open to $7,459. Price then started to continue to drive higher. Now that gap, as we spoke about yesterday, was driven by the US and Iran situation, where there was a pause, not a de-escalation, not a ceasefire, a pause in the bombing, right, between the US and Iran. Now, as we kind of go into and look at what happened going overnight, we also have a lot of tech earnings coming out. We have a lot of company earnings coming out as well. We also this week have the Federal Reserve interest rate decision, where there is a higher probability that the market will hold interest rates going into this meeting. But I just wanted to bring on a couple of different things first, and we're going to talk about what impacts the S&P 500 first. Well, there's a lot of factors. First of all, geopolitical risk. That's obviously heightened at the moment. That's having an impact on these markets. What we tend to see, if oil prices start to rally, we actually start to see that impact inflation expectations. We see bond yields start to rise, which have a negative impact on the S&P 500 because it potentially points to rate hikes. Okay, if inflation is persistent and rates do hike, that can be negative for businesses because their borrowing costs go up. You know, their cost of doing business goes up. So they perform well in low interest rate environments versus high interest rate environments. Just to show you before we kind of dive right into the current price action, let's just prove that, right? So when we talk about what's happened in the past, let's look at 2022. So in 2022, between the period of sort of, you know, the start of that year, January, all the way through to October, inflation started to become very persistent. We started to see large increases in inflation. And what the market then priced was the fact that we were going to see interest rate hikes from the Federal Reserve. What did that cause? Well, price action ended up falling. It started a lovely sort of weekly downward trend, which saw prices go from at that time, the all-time highs of $4,783, all the way down to the lows of $3,560. So when we look at that range there, that's quite a significant decrease in price. You know, if I go back to TradingView for a quick second and just have a look at that area, we can have a look at the 2022 pullback, and we can measure that pullback in terms of percentage. That was a 25% decline in the price of the S&P 500. So now, you know, we're starting to bubble again on the idea that we're going to see a potential rate hike from the Fed. Now, traders are trying to gauge whether it's going to be more than one or two hikes, you know, and if it is, what does that mean for the likes of the S&P 500, for the likes of businesses in the market? Now, if I take a look at the US 2-year bond yields, currently trading around 4.2%, 4.35%, right? The current interest rate in the US right now is 3.75%, right? So if I just grab the US interest rates down through here, you can see that that is currently at 3.7%. So it's around that 3.7, 3.75% mark. So the deviation between that is still getting stronger, right? We're seeing an increase in the deviation between current rates and the US 2-year yields. Now, typically when that happens, we can see interest rate hikes, right? But it hasn't, aggressively pulled away just yet. If we start to see US 2-year yields at 4.5%, perhaps even 5%, then that's a bigger chance that we are going to see an increase, because this is basically telling us where most bond traders think the yield is going to be, right? So looking at this chart here, you can see back in 2021, inflation started to sort of rise and become persistent. So that started to get priced into the US bond yields, where we saw that increase. Now in March of 2022, the Federal Reserve started to hike, but inflation was still hot. We were still seeing inflation continue to rise. So US bond yields continued to rally and rally and rally. And so we saw the jumps in interest rate hikes from the Federal Reserve, which then peaked in July of 2024. But you can already see by November and October, which we just showed you on the S&P 500 chart, at that point, pretty much bond yields peaked. We just started to go a little bit sideways, if anything. And that was the low that formed on the S&P 500. Because then markets, because interest rates had hiked so much, they were expecting less demand, and that interest rates would start to come lower, which they eventually did. And that obviously helped with the S&P 500 move to the upside. But if we have a little look at the S&P 500 now, and have a look at how the market is going to be impacted by this, let's just say we had another 25% decline, right? That would bring price all the way down into sort of the $5,800, $5,700 area. That's quite a big decline, and we don't have inflation as aggressive as we did in 2021. So the likelihood of that is less likely. However, if we take a look at the previous kind of structure highs on the weekly chart, around $7,000, right? That doesn't look impossible, right? That would only be, from current prices, an extra 5% decline. And that is very likely. If we do see interest rate hikes coming in, and we do see the Federal Reserve get aggressive with rate hikes and be a little bit more on the hawkish side this week, there could be scope for the S&P 500 to trade lower. Combined with that, we have in earnings coming out, right? We have some quite big earnings coming out this week. I believe we have Nvidia coming out this week, and big earnings like that. Let me just see if there is a bit of news here that we can kind of look at when it comes to US stocks and equities there. Let me just see the earnings calendar this week. So yeah, we've got 28. So today we've got Visa. We've got Visa coming out today. Coca-Cola coming out today as well after market close. Rio Tinto as well, which is deals with metals as well, coming out. Seagate, Boeing. So we actually have quite a lot. Unilever as well, which is something I just said. We have a huge week. I wanted to see when the Nvidia one comes out, whether Nvidia reporting has already happened, because we've got lots of earnings coming out today after market close. You got Barclays. What else do we have? EA Sports. I wanted to see when Nvidia's was coming out. Let me see if I can search for company. So Nvidia's has come out, sorry. So that was on the... oh no, Nvidia's next one is the 26th of August. So they might have already come out. Let me have a quick look at my chart here, just to see if that did come out. Next report is August 26th. Okay. I thought we had Nvidia this week, but it doesn't seem like we did. Okay, so either way, we do have quite a large earnings week as well. And, you know, if any of those are involving kind of technology, tech, chip making, anything to do with that, then there could be some serious declines here, because we're starting to see the AI trade and the AI chip making trade start to unravel a little bit. We're basically seeing a lot of revenue that doesn't really match up to the cost of what this is creating for certain businesses. You know, if we check out Amazon, for instance, we can see that Amazon has been declining over the past couple of weeks. Google as well has also been facing some declines as well because of their revenue issues and their estimated revenue. So large cap companies that make up, you know, parts of the S&P 500 are starting to become a little bit bearish. So that is having an impact on what's going on as well. So the downside to the market, looks like we could see a little bit more downside to the S&P 500 in the near future. Now, if we look at it from a technical perspective, you know, the market is in that kind of consolidative phase. We do have kind of higher lows, but recently those have been broken. We've also closed below the daily 50 moving average. If I look at the daily 200 moving average and just see where that sits on our chart, that sits around that $7,000 level that we were just discussing from the weekly level of support. So looking at this, it looks like we are opening ourselves up to a little bit more downside. If I look at the 4-hour chart, 50 moving average is crossing the 200 moving average now, and we could see that obviously give a little bit more of a bearish reading. Support levels would be those previous lows. So you've got $7,300 as a low, 7,260 as a low. Those two areas there could be targets for, you know, downside activity or downside pressure. If we do break below 7,258, to me, that is a strong idea that we're going to start pushing more towards that $7,000 level at that point. Really tricky to sell stocks. Obviously, we can do that as a CFD broker. You can buy and sell the stock market, which gives us great flexibility. So, you know, for those that just hold portfolios and holding, wishing that the market would go back to the upside, yeah, it's a great strategy over, you know, years if you're willing to hold it for years. But in the here and now, you know, using a CFD to trade these kind of markets can give you a little bit more flexibility, a little bit more options going forward. So I like the idea of maybe if price does kind of, you know, rebound from current prices back up into sort of 7,460, that could be a good resistance point. We can see sellers came in there recently, and that's why we closed the gap. But also, if we consolidate at these lows, break lower, that also would give me a bit of a bearish reading when it comes to the S&P 500. Let's move on to the next story then. So the big story of the day is we're going to be talking about the Euro, US dollar, and gold prices ahead of the Federal Reserve coming in tomorrow. So big meeting tomorrow. Big meeting tomorrow. We've got the Federal Reserve interest rate decision. Now, whenever we look at interest rate decisions, I like to look at a few different tools that can help us kind of gauge what the market is thinking. First of all, let's take a look at the CME Fed Watch tool. Okay, we've talked about this time and time again. But the CME Fed Watch tool basically gives us an insight into what bond traders are thinking about when it comes to the expectations of the Fed. Okay, now I always like to do a little bit of a game plan when it comes to the Fed event because so many different things can happen. So we're going to talk about the game plan too. But what does the market suggest right now? So going into tomorrow's meeting, at the moment there is only a 33.7% chance of an interest rate hike and a 66% chance of no change. So the market is more on the side of a no change. Now that has been changing quite dramatically. We have actually seen expectations of a hike go up. So probability last week was only at 25.7%. Going into yesterday, it was 37%, but has now come down to 33%. So there, the market has been kind of fluctuating on interest rate hikes versus kind of on the easing side of things. So the probability of a hike going into today, if we get some significant points of data today that drags that from a hold of 66% lower and a chance of a hike higher, that would be bullish US dollars. That would be very much bullish US bond yields, very much negative downside on gold, and euro US dollar would also be negative in that particular scenario. If we look at September's rate hike chances, that has gone up to 79%. So a while ago that wasn't that aggressive. If anything, rates being at 400 to 425 basis points have increased. A month ago that was only 12.6%. Now it's at 23.2%. So the market is expecting a couple of hikes. Okay, the market is expecting a couple of interest rate hikes from the Federal Reserve. Now, when we talk about what's been going on in the US, it's also important to talk about what's driving this. And a lot of it is to do with the geopolitical tension between the US and Iran. Because if we look at genuine indicators coming out of the likes of the US, so let's just take a quick look at kind of the GDP growth. So GDP growth is 2.1%. That has increased. Inflation rate is at 3.5%, so still above targets of 2 to 3% range. The jobless rate is at 4.2%. So if we go take a look at those in a little bit more detail, we can see what has the path for those been. So if we look at the GDP growth rate, the previous quarter in Q4 was 0.5%, Q1 2.1%. Expectations going forward is 2.2%. So growth is expected to continue to rise in the United States, which is usually, again, a good thing for currencies, good thing for bond yields. If we take a look at the inflation rate has come down substantially from 4.2% to 3.5%. If we look at the core inflation rate month on month, that has also dropped. Highs in April of 0.4%, and now in June, the reading was 0%. So those have also come in much, much lower. If you're looking at year on year as well, for the core inflation, dropped from 2.9% to 2.6%. So inflation is coming down. It is heading towards targets. So, this is why the market is trying to price in cuts, because Federal Chair Walsh has been very outspoken on the dual mandate and specifically the inflation rate, wanting to bring that inflation within target range. He's been very aggressive in his tone when it comes to that. So the market is kind of expecting a little bit of the same again. Let's look at the CME Fed, not the CME Fed Watch Tool, sorry, we've already looked at that. Let's look at the interest rate tracker to see if they can get any kind of insights here on what's going to happen as well. So when we look at the Federal Reserve, there is obviously that 63% chance of a hold, and a 36% chance of a hike that we just looked at. So looking at the kind of notes here on Financial Source, we can see that the majority of Fed bankers are neutral. Dovish 1, neutral 11, hawkish 9. The overall tone is neutral because the majority of recent comments from the Federal Reserve reflects a balanced perspective. Okay, so we've seen a lot of talk about the impact of the escalations between the US and Iran too, because it says here, notably, Vice Chair Jefferson emphasized the need to consider the entire economy when setting policy and acknowledged the dual mandates tension, indicating a cautious approach to any potential political shifts, policy shifts. While there are concerns about inflation's persistent on the impact of AI on the economy, the majority of officials are leaning neutral, suggesting they are not inclined to make immediate changes to the current policy stance. So that's why we're seeing a hold this meeting, but potentially, a 25 basis points hike or a 50 basis points hike in September. So it'd be interesting to see the comments from Fed Warsh, but let's have a little look at the charts and where things are positioning at the moment, because when we take a look at the likes of gold, we can see that we are starting to see some downside again. We had a little bit of a breakout on the 21st of July, and we saw prices rally from $4,050 all the way up into the $4,159. But that didn't make sense to me. It didn't make sense to me because US bond yields were also rising at that time. So on the Thursday, we talked about the potential breakout on Thursday, the 23rd, of a downside move, and we had this lovely head and shoulders pattern. And the market broke out of this head and shoulders pattern and continued to trade lower. Since then, the market gapped on Sunday because of that somewhat positive data from the US-Iran war, that there was just a pause in fighting. But since then, the market broke down, retested a key area of resistance, and filled that gap. Okay, so that gap is now filled. Prices are looking pretty bearish here, especially on the 30-minute time frame, and we could see a move back towards $4,000. This $4,000 level, I think, is going to be pretty crucial going forward, right? If we see the Federal Reserve, almost agree with the market sentiment that we could see more aggressive hikes in the future to bring that inflation rate down, then that $4,000 level is looking pretty vulnerable, and we could see a break below it, which means we could see a move down towards at least $3,500 on gold. If, however, the market finds support down at $4,000, and let's say Federal Reserve Chairman Warsh comes out and says, actually, we think, policy is restrictive enough, we're seeing positive declines in inflation, and we actually don't feel the need to hike interest rates at this current moment in time, then a rebound at that $4,000 level could be likely, with a move up to at least $4,200, or this $4,190 resistance that forms. So really speaking, gold has been in a little bit of a range, right, since the end of June, start of July, because it's waiting and anticipating what the Federal Reserve are going to do next in terms of policy. Now, we know Fed Chair Warsh doesn't really want to give any forward guidance, but that means that we have to lean on the data going forward. So if after the fact CPI, because we've got core PCE as well coming up, if that does show further declines, then I think gold prices will start to be a little bit more bullish. If it shows an increase or a hold, gold's chances of moving lower get stronger at that point. Okay, so let's look at euro dollar and where euro dollar currently sits. We did yesterday discuss a potential reversal on euro dollar if prices can reach the 112, 111.50 handle, because we are seeing hedge funds short euro at extreme levels. And again, look at this, price has pretty much ranged since the middle of June going into today, because again, there's no real kind of direction for the market at the moment. We get positive jobs data in the US, positive growth data, and we've got lowering inflation. So it's a bit of a kind of like a mixed bag at the minute. So again, what is Federal Warsh going to say? If he says something to do with being more restrictive and trying to bring inflation in line, euro dollar could break out of its current daily trading range, which has a low of 113.30 and a high of 114.60. So that could mean we see a breakout to the downside towards that 112 handle. If, however, we see, Fed Chair Warsh give a little bit more of a dovish turn, then we could see a move within that range back up to 114.60 resistance. So that's something to think about when it comes to the Federal Reserve interest rate decision going into tomorrow. So we're going to match this up with our skill of the day. Our skill of the day is going to be how to handle pre-news consolidation and ranges. Okay, So before high impact tier 1 events like the federal interest rate decision, markets often enter low volatility coiling stage or rectangular range. That's exactly what we've just been talking about on gold prices and on euro US dollar. It coils because it doesn't know. There's a lot of indecision around. Okay. Now, the thing is, with retail traders, they try to just trade it technically anyway, right? So let's just look at this. For instance, we've had a bearish downward trend. The market has been consolidating, but they will be looking for sort of continuations of that trend. So let's say, for instance, we have this supporting trend line. The market has broken and closed below it. Retail traders would happily short that, stops above the high, going into an event that they may not understand. Okay, so when it comes to large events and ranges, you're better off waiting for the decision to happen and then look for a trading opportunity. Okay, so what a lot of professionals do versus retail traders is they wait for the announcement and then they understand how that is going to impact the market going forward. And if it impacts it in a positive way, then you'll see a positive reaction and a continuation. Let's say, for instance, euro dollar has been trading to the downside. Let's say Federal Reserve comes out, they're very hawkish in their tone. That matches the current trend. So the narrative here doesn't change. So any kind of breakouts can be met with some short selling. However, if they do come out and be a little bit more dovish in tone, that changes the narrative here for euro dollar completely, because we're in this downward trend. So what we could actually see there is a break above key resistance points. And then it's about, is that going to be sustained? What kind of data do we need to see it sustained? And if it is, then the reversals start to form. So the difference between kind of amateurs and professionals when it comes to handling these pre-news consolidations and ranges is professionals wait for the move and then they look to get back onto it. Now, this doesn't have to be, I'm looking at a daily chart here. It doesn't have to be that. You can look at it sort of 15 minutes, 20 minutes before the event. Really good example of this is when we traded gold previously. We were looking at CPI, right? And this is a really good example of this because we were trading gold back here, right? And this is an example trade that I have shown you before. But on 14th of July, we had a very positive CPI number. The CPI came in a lot lower, right? And gold prices rallied. Gold prices rallied because we saw quite a reaction on the bond market as well. Bond yields started to fall and we had that move. But what happens is retail traders try and chase that breakout, right? They try and buy that move. Now, what professionals do is they look for volume areas. They look for accumulation areas for areas of support. So for instance, when we look at this market profile of gold on the 14th of July, there was all this accumulation down towards $4,017. After the CPI news came out, price was trading at 4,076. Now, as a retail trader, if you're buying there, where are you putting your stop losses? You're putting them below the swing lows, and the risk reward gets really skewed. Now, if we take a look at what's happened since then, or the day after, gold drifted lower, right? So traders, retail traders, probably offside in this move. It comes back into the market profile level of support, and guess what? It rallies, right? Now, the trade that I took was a little bit different because we had the PPI the day after, right? And if you look at what happened on PPI, it had a pretty similar reaction to CPI. So we had a move where the market rejected that consolidation of the previous day, but it consolidated at that level. It then broke through on the positive PPI data, right? And then drifted back down. Where did it find support? It found support at the point of control of that accumulation area. Market rallied, and that was the trade. I bought on the rejection of that point of control, sold at a 2-to-1 risk reward ratio. But that is how you can look at news events a little bit differently. Look for the accumulation before the event. Wait for the breakout. Ask yourself the question, how is this going to impact the market going forward? And if you are on the right side of that move, you can catch these nice little retests and continuations, right? So keep an eye on that going forward. Obviously, it's a little bit different when you're trading news events. It can be difficult to trade those. So make sure that you have these kind of key levels locked in place before you do that. And always keep risk low when you're trading on high impact news events, because there can be often slippages and things like that. So thanks for joining me today. That's all I've got for you for the markets in 3. Hope you enjoyed it. If you did, leave it a thumbs up, subscribe if you are new around here, and I will speak to you tomorrow, same time.